Deepa Agarwal ma'am, and our committee members, CA Ashish Jain sir, Chairman of Agra branch, CA Gaurav Bansal sir, Vice Chairman of Agra branch, CA Deepika Mittal ma'am, Secretary of Agra branch, CA Saurabh Sharma sir, Treasurer of Agra branch, CA Sharma Agarwal sir, Managing Committee member, and CA Rakesh Agarwal sir, Sikasa Chairman, and other members of Agra branch. As we have already witnessed that COVID has changed everyone's life, but one need to move ahead. Now moving further, if we look into the past, due to the increase in number of frauds, manipulations, the auditors are on the radar of most of the regulators. To protect our fellow members from such fraud and to enhance the quality and relevance on auditing practices, one need to comply with standards on auditing. So we have gathered here to get guidance in performing audit and bring consistency in reporting. Now, I would like to request Chairman of Agra Branch CIRC, CA Ashish Jain sir, for his welcome address.
Thank you, Akanksha. First of all, a very good evening to all of you present here, all the members, and I could see many members outside Agra, so a warm welcome to them. A welcome to a preeminent speaker, CA Deepa Agarwal, who is, I think, for the first time is a speaker with Agra branch, to my knowledge, and my colleagues in the managing committee and friends. In our exercise of Agra branch for back to basics, I think this is a sequence of a seminar where from accounting standards to standards on auditing, where we have considered accounting standards, the way we are drafting the balance sheets, the lacunas which we are leaving around. And now, as we understand it, the way peer review is being conducted and the regulators are expecting from us. So again, from back to basics, standards on auditing are again integral part of our basics, and we need to restore rather, or we need to work again on it, because with the passage of time, we leave around few things in the updations, specifically mainly the updations which we should know, but maybe due to other constraints and other taxation revenue matters, we leave the standards on auditing or accounting behind. Last week on the Agra branch hosted a 2-day conference on artificial intelligence and forensics, accounting and investigation, and from that again back to the standards on auditing in itself shows that how important the topic is, and we consider it to be a very important one. So with this, we have a very learned speaker, Deepa Agarwal, who has been taking sessions on this topic from past many years. So hope that you will enjoy this, and with this, I once again welcome you all for this today's VCM. Thank you.
Thank you, sir. Thank you, sir, for your kind words. Now, before handing over the proceedings to our speaker, I am pleased to introduce our today's speaker, CA Deepa Agarwal ma'am. She has secured 13 All India rank and 5th rank in NIRC. She has almost 20 years of experience in serving national and multinational companies in the areas of auditing and accounting, corporate laws, and other related matters. She has completed Information System Audit course from ICAI in September 2006 and certified course on IFRS from ICAI in March 2011. She has worked with the Technical Directorate of ICAI for around 5 years and has assisted ICAI in various publications such as Guidance Note on CARO 2020, COVID Guide on Physical Verification of Inventory, Audit Reporting, Background Material on AS16, Technical Guide on Accounting and Auditing Issues in CHIT and in CHIT Fund. She has been working with renowned consultancy firm from almost 14 years. She was a special invitee on AASB of the ICAI for the last 2 years and special invitee on Corporate Laws and Governance Committee of the ICAI currently. She has worked on publications, projects, and assurance standards. She has authored 3 publications. She has worked on preparation of comments, guidance, and presentations on Companies Bill and Companies Act 2013. She acted as a faculty member for the ICAI course organized by INAS IFRS Implementation Committee and Board of Studies. She acted as a speaker in seminars on accounting, auditing, Companies Act matters at various platforms. She has imparted training to chartered accountants on accounting standards in AS, auditing standards, and other updates. Ma'am, we are blessed to have you here, ma'am. Now I hand over the proceedings to our speaker, CA Deepa Agarwal, ma'am. Over to you, ma'am.
Thank you so much, Akansha. Thank you for your kind words. And thank you, Ashish, for setting the right background. Good afternoon, everyone. And I welcome to all of you. And yes, you're right. I'm taking the first session in this Agra branch, but number of sessions, I've taken from in the NIRC and in the even in the students organization, the session they keep on organizing. And whenever I get a call from the ICAI, even if at a shorter notice, I believe that it's a privilege because I always believe that it's a two-way learning. So Kansha, it's not just you guys. I mean, it's for me also. I think that's why where will I begin the session. Will request everyone to make it participative, interactive, ask questions, unmute yourself if you want to share your experience. And as Ashish rightly mentioned that, with the increasing expectation of the stakeholders, and with the fact that the auditor's responsibilities are increasing. Akansha mentioned about CARO 2020. Yes, I worked there as I was part of the study group for preparation of the guidance note. And all of you would have noticed that this morning, the Corporate Laws Committee of the ICAI has issued the Schedule 3 guidance note, the exposure draft. Yesterday, we had a meeting and the guidance note is out now for your reading and comments. So if you will look at the number of changes which have been done now in Schedule 3 and therefore in CARO 2020, and when I talk about the auditor's role and responsibility, it's increased significantly. The increase in the reporting requirement is tremendous. So for a minute, if I just talk about CARO, the reporting requirement have been changed from 21 clauses to now 50 clauses and sub clauses put together. Now with this background, I'll just share my screen. Akansha, I can share my screen, right? Yeah.
Yes, ma'am.
Okay. Let me know once it's visible.
Yes, ma'am, visible.
Okay, thank you. So I'm sure the next 2 hours or so, when we are going to deliberate on the Statutory Audit under Companies Act and the auditing standard compliance. So why I linked with the statutory audit, because the fact that the auditing standard have also been recognized under Section 143(10) of the Companies Act. It is mandatory. The standards are mandatory for every company, for every audit. So if you look at the guidance note on tax audit, they have been very clearly given that for expressing a true and fair view, you have to make sure that the company or the entity is complying with the accounting standards, with the auditing standard. And when, as an auditor, you put your signatures, you issue an audit report, it is very important to see that are we complying with all the applicable auditing standards. So again, my request that let's make the session more interactive. Keep on writing your questions in the chat box. I'll try and answer in between to make the session more interactive. So, let's talk about why role of auditor is important and why auditor's report is important. It's relied on by the large number of stakeholders, regulators, investors. So auditing today somewhere is facing a crisis of trust. Why? Because so many frauds are happening. You would have heard about the collapse of the largest NBFC and the arising out of the impact not only on the investors but the stakeholders, bankers, public money is getting lost. And therefore, a lot of questions are being asked for the auditors, what was auditor doing and why auditors have not detected it earlier. So if some of you have seen, NAFRA has issued 3 reports till now. They called it as AQR report. It is there on the website of NAFRA. Initially, they issued 1 report of a large firm, and then they issued another report. And the 3rd report is there of the recently Jayaprakash and Associates report. And if you look at the reports, the themes are largely talking about the audit procedures, communicating with the management, and they will talk about, in fact, the recent report points out on the reporting as well. The auditor has used large number of emphasis of meta paragraph, and therefore they believe that the EUM should not be used. I mean, 8 EUMs in a report is something not what is envisaged in the standard. And if there are matters which should be qualified, then it should be depending on whether it's a qualification. The auditor needs to see whether he or she needs to issue a qualified report or adverse opinion or a disclaimer of opinion. I will cover some of the specific observations towards the end of the slide, just to give a brief overview. So restoring public faith in auditor will require action from many players, including investors, client board and management, regulators, media, because what happens if any fraud happens, first of all, everyone starts thinking about, who was the auditor, and it must be the situation where an auditor has not done his work, has not exercised his or her due diligence, or they have not exercised professional judgment appropriately. But above all, that will also require action from the auditor, from each one of you when you are acting as an auditor. Even if you are working for a company, you are a practicing chartered accountant, I think it is a very responsible role given to you on, and the expectation is increasing day by day. So work product, whatever you have done, ultimately the audit report has to be issued, be it be it the audit report of a company or a society or a trust. So huge responsibility of the auditors, and therefore you would have seen in the last, if you even talk about the last 2 years, so many regulations for the auditors, including the SEBI regulation. They keep on revising the resignation requirement, the filing of the fact, the company has to file whenever the auditor resigns within a period of 24 hours. So the CARO I mentioned, increasing expectation. So we will discuss about the detailed requirements in the coming slide. Now let's understand first what is the auditor. When you say back to basics, so again, it is very important to understand the responsibility of the auditor. Auditor needs to report that to the best of his information and knowledge, the financial statement give a true and fair view of the state of company's affair as at the end of the financial year. So auditor has to give a true and fair view of the state of company's affair. And for that, they need to make sure that these standards in auditing have been complied with. I have structured my presentation and try and cover all the important standards in auditing in the coming slide. And what is an audit? As we all know, audit is an independent examination of financial information of any entity. So when I mentioned about Schedule 3, so from March 22 onwards, you will see a more comprehensive set of financial statement with detailed disclosures, even the regulatory information. So the CARO the reporting requirements for CARO, which are there for the auditor, similar kind of information has been added for the company to present in the financial statement. So that also the auditor will have to see, and not just the March 2022, they will have to think about the comparatives also. So the company will provide the comparative information, and as an auditor, we need to think, how do we verify, how do we check the comparative information, and if the company has not given a comparative information, then what are the implications and what are the impact on the audit report. So one important point, I think, which the regulators should also understand, whenever we get any notices from the QRB or from MCA or from ROC, the important point is audit is not an investigation into alleged wrongdoing. Audit is not given specific legal power, such as a power of search, which may be necessary for such an investigation. So if a fraud, if there is a whistleblower complaint in a company and a fraud is to be conducted, it is very important to understand that the role of the auditor is not to conduct a forensic investigation. For that, we have separate expert. The company may want to hire forensic expert, or the company may want to engage another chartered accountant for conducting such forensic audit or forensic investigation. However, given the role under Section 143(10) and under Section 143 of the Companies Act, the responsibility of the auditor is to examine the financial statement and to give a true and fair view. Now, looking at the concept of the true and fair view. So management is responsible for preparation of the financial statement such that the financial statement represents true and fair view. True and fair view means that the financial statement is free from material misstatement, which means you have checked all the underlying books of account. You have seen that whatever misstatements are there, you have discussed with the management. The management has made appropriate adjustments, and The financial statement represent the financial position, financial performance, and cash flows. Now, if you look at the sorry, if you look at these boxes here, so this is something to explain the entire process. So one, compliance with Companies Act 2013 requirements. It encompasses whole set of requirements. So be it your section 185, 186, when you talk about compliance with, the specific provision of loans and investment, when you talk about the related party transactions, when you talk about the board resolution, when you talk about the audit committee in case of listed company, the auditor will have to see whether the company has complied with the provision of the Companies Act. Proper maintenance of account and other and matters connected therewith. So here it comes into play section 128 of the Companies Act. So section 128 requires the company to maintain books of account on accrual system of accounting. Sorry. And therefore it is very important that the company has maintained proper books of account. And if you recollect, there is a announcement issued by the MCA on 26th March, wherein they amended the auditor amendment rules and also the accounts rule. In the accounts rule, they have introduced a provision on maintenance of audit trail, which means that with effect from 1st April 2022. So the applicability date was deferred later, but now the situation is with effect from next year, which is your next year, just 6 months away. The company using an accounting software will have to make sure that whatever software they are using should maintain an audit trail. So for each and every entry they're passing, for each and every entry they're amending or making an adjustment should be supported by an audit log and for which the auditor will check at the end of the year. The auditor will audit that log and will have to include a specific reporting as part of the auditor report. So if you look at the proper maintenance of account in section 128 only, they have added a proviso wherein they have added this additional provision for maintenance of audit trail. It is applicable from next year onwards. Preparation of the financial statements or the annual account in accordance with applicable accounting standards. So you have Indian GAAP, which is your company's accounting standard rules 2006, and that also has been amended. And now they will be companies accounting standards rules 2021, and that will be applicable from next year, which means 1st April 22 onwards. But this is something again, one has to check the applicable framework, applicable accounting standard while issuing an audit report, and selection of accounting policies and applying them consistently and making judgment. Now, judgment and estimate that are reasonable and prudent. So professional judgment is something which an auditor has to exercise throughout audit. Management will exercise judgment, make an estimation while carrying out impairment assessment, but the auditor will also have to exercise judgment and estimate while giving an audit report. Safeguarding asset and preventing and detecting fraud and other irregularities. So again, the responsibilities of the management, but the auditor will have to check whether management has taken all such steps that are important for detecting fraud and other non-compliance with laws and regulation. Then establishing internal financial control, the management will establish internal financial control. Again, the responsibility is cast on the auditor under section 143(3)(I), that the auditor will have to report whether the company has established effective internal control and they are operating effectively with reference to the financial statement. So again, the corresponding responsibility has been cast on the auditor as well. Now let's look at the auditor's duties under 2013 Act and auditor's rights and obligations. So, or the right which the auditor has. So auditor has access to books of account. Auditors should have access to books of account, which means the unrestricted access to books of account, obtain information and explanation from the company. So these rights are empowered or given under the Act. So if the management is not cooperating with you, they are not giving you the information on time or what is needed to make sure that you obtain sufficient evidence, then you have all the right to issue a disclaimer of opinion. So the auditing standard empowers you that if there is the information is not available to you, then you will refer SA 705, which talks about scope limitation, which means the information is not being available to you because of the limitation in scope imposed by the management. And in that case, you will issue a disclaimer of opinion. So again, not an easy situation. You will see very limited examples in public domain for the listed company wherein the auditors are giving disclaimer of opinion or adverse opinion. But if I just share my experience in a private company, there are many cases where it happens if there is a, let's say, a shareholder dispute and the financial statements have not been adopted, or they have not been given, the information is not given to the auditor, then there is no choice but to issue a disclaimer of opinion. The specific duties on the auditor. The auditor has to make specific inquiries for reporting and as part of the auditor report. For example, whether personal expenses have been charged to revenue, comply with auditing standards, and report on specific matters. So those matters, the one which I mentioned in the beginning, that there has been amendment on 26 March in the auditor rules as well, and they have amended the specific specific sections, or they have added the specific reporting requirement under report on other legal and regulatory requirement. So the auditor will have to report on utilization of borrowing, dividend norms, whether the company has declared dividend in accordance with the requirements of the Companies Act, audit trail, whether the company has maintained an audit trail, and there is no, and it is operating effectively. So in a way, there is every adjustment or every the entry which has been recorded by the management is demonstrated by an audit trail. The auditor has a specific reporting on fraud. So we will talk about in detail about the reporting requirements in CARO, CARO 2016, CARO 2020, and under section 143.12, wherein the auditor may have to report to the central government. Internal financial control reporting under section 143.3i and CARO reporting. Auditor to also comply with ICAI pronouncements to the extent applicable. So it means in addition to these standards in auditing, if you will go to the AASB web page, the website of the ICAI, you will see various pronouncements on the website of the ICAI. Now, that can be issued by the AASB, by any other committee of the ICAI. So it is important for, to keep updated yourself of such pronouncement before issuing an opinion on the audit report. So it's not just the standards in auditing. You may have to refer to a guidance note. You may have to refer to a technical guide. You may have to refer to any of the announcement issued by the ICAI. Now, let's talk about the management responsibilities in an audit. The words, the financial statement are the responsibility of management, appear prominently in an auditor's report. So if you look at the auditor's report, and I'll just show you in some time the auditor's report as well, just to make the session more interactive. So if you remember the lines in the management responsibility paragraph, you write the financial statement are the responsibility of the management. So the preparation lies with the management. Without management having responsibility for the financial statement, the demarcation line that determines the auditor's independence and objectivity regarding the client and the audit engagement would not be clear. Auditing standards are very clear. If you look at the structure of any of the auditing standard, even the, you pick up any standard, they talk about what is the objective of the standard, what is the management responsibility. So in any of the auditing standard, for example, as the 240 on fraud, the standard itself will explain it is the responsibility of the management to make sure that they are able to detect fraud on a timely basis, report to the auditor, and auditors should also have a responsibility to conduct those checks. But what is clearly envisaged and clearly explained in both in the Companies Act as well as in the standards in auditing, the management has a responsibility to prepare and present the financial statement in accordance with the applicable financial reporting framework, which could be your any GAAP, Indian GAAP, Ind AS, to provide the auditor with the following information: all records, documentation, and other matters relevant to the preparation and presentation of the financial statement, any additional information that the auditor may request. So, for example, if you are conducting, inventory verification, you may have to get the additional information from the management. So the auditor has a right to obtain the additional information from the management, unrestricted access to those within the organization if the auditor determines it necessary to obtain audit evidence objectivity. So within the auditing standard, you will find these clauses wherein you have the right to obtain the information from the management whenever required before issuing a true and fair view. Now, what auditors don't do. Now, this slide talks about what auditors don't do. So auditor do not take responsibility for preparation of the financial statement on which they form an opinion. These are some of the tasks which one should not expect auditor to do. So if anybody is telling you, pick up the auditing standard, clarify to respond to such notices. It is not the responsibility of an auditor to close the books of account, to select accounting policies, to establish account coding or classification. This is the responsibility of the management. Now, advantages and disadvantages. So yes, the audit is something which is a very important responsibility cast on by the regulators, by the stakeholders. So if you have issued an audit report, as an auditor, you have certified something that enhances the degree of confidence of intended users. So I'm sure many of you would have faced that day in, day out, regulators keep on asking about certificates, that for claiming a particular incentive and a subsidy, even for submission of a tender document, they want a certificate from the statutory auditor. Why they want a certificate from a statutory auditor? Because the regulators believe that the degree of the confidence or the underlying information, the fact that the underlying information is correct and accurate, will be increased, will be substantiated further if the auditor has certified the underlying information. Yes, the objective of the regulator is to make sure that the interest of the stakeholder is safeguarded when the information is audited, and a fair determination of the government dues and appraisal of various controls. So again, the advantages of the audited are number of advantages, but at the same time, there are some limitations as well. Auditor, again, it depends on the professional judgment of the auditor. We'll talk about materiality. So the auditor has right to determine its materiality, performing test checks. So obviously you cannot do 100% checking. You may rely on test check. Depending on the size of the organization. Again, many cases, the auditor may not be able to detect fraud, particularly fraud involving senior management or collusion, existence and completeness, related party relationship and transactions, non-compliance with laws and regulations. Now, due to these inherent limitation, auditor cannot reduce audit risk to zero and cannot therefore obtain absolute assurance that the financial statements are free from material misstatement due to fraud or error. So which means you cannot give an absolute assurance, you cannot give any 100% assurance, you can only give a reasonable assurance. And therefore, the auditing standard talks about true and fair view of the financial statements. Now I'm moving on to the next slide on the nature, objective, and scope of an audit. Now, what are the overall objectives of the independent auditor? That is your mother standard, which is called as SS 200. So that talks about the overall objectives of the independent auditor. The auditor's objective is to ensure that the financial statement as a whole are free from material misstatement. The auditor has to give a reasonable assurance and report on the financial statement. So what is a reasonable assurance? A high level of assurance, but not an absolute level of assurance, because there are inherent limitations, as we have discussed in the previous slide, which results in most of the audit evidence on which the auditor draws conclusion and base the auditor's opinion being persuasive rather than conclusive. Now, these lines, that audit is not a guarantee. If you look at SS 700 report, that is also mentioned in the audit report. So it is not a guarantee. The audit is not a guarantee that an audit conducted in accordance with the standards in auditing will always detect a material misstatement when it exists. Therefore, it is very important to understand that whenever any fraud happens, it is not always that the auditor was responsible. If the management has designed the fraud in such a way that the auditor in the performance of his or her duty is not able to determine it, there was no such evidence or indication, then obviously the auditor cannot give a guarantee that even if you conduct your audit, that you will always detect a material misstatement. Now, this slide just gives an overview of the different auditing standards. I just want to give you an overview of the structure, the way our standards are divided. So one is your auditor standards, which are recognized under section 143.10 and which you use when you issue an audit report, your statutory audit report under Companies Act. So it provides a reasonable assurance and you give a positive assurance. In review, for example, you have a quarterly review, right, for a listed company. So companies which are listed on a stock exchange, whether it's equity listed or debt listed. So debt listed have a 6-monthly reporting requirement. For equity listed, there's a quarterly reporting requirement. Therein you will use SRE 2410, which is your review standard. And review standard, you will give a moderate assurance. And even if I talk about unlisted companies, unlisted company may also want to issue a review report for the purpose of the management, or there could be, any such requirement. then also they will use SRE 2410. In a review report, if you look at the assertion or the opinion paragraph, you give a negative assurance, which means you mention that nothing has come to your notice, which makes you believe that the financial information contains any material misstatement. So that is called a negative assurance. Just want to make a point here. If some of you have not read the Companies Amendment Act 2020, there was a section added under section 129A of the Companies Act, under which now the central government has the power to indicate or to notify a certain set of companies, the unlisted company, which will require to do a which will require to submit financial information at a monthly or a quarterly or a periodic intervals. So the central government will come out with rules, and even the unlisted company will be required to submit information like listed companies on a periodic interval basis, which could be even 6 months, which could be on a quarterly basis, in addition to the annual results. So in addition to the annual financial statement. So that rules have yet to be notified, but you can check there is section 129A, which refers to the respective provision given to the central government under Companies Act 2020, under Companies Act Amendment Act 2020. On related service, you have certain other set of standard, which is agreed upon procedure. SRS 4400, again, very widely used wherever you need to issue a AUP report, which is called the agreed upon procedure. So at times the requirement is so onerous that you won't be able to issue a certificate. So for certificate, you have a guidance note separately, guidance note on certificate and special purpose report. But if you cannot issue a certificate and management just want you to conduct some procedure on a certain specified set of information, then the auditor can issue a agreed upon procedures report. It's a factual finding of procedure. Therefore, there is no assurance. So it is not a positive assurance, not a negative assurance, but in SRS 4400, you have a factual finding of procedures. Then you have the compilation standard. Again, no assurance here, but the chartered accountant or the independent practitioner helps here in compilation of the information and issue a report accordingly. Aspects of the financial statements in an audit. So an examination of the system of accounting to ascertain whether it is appropriate for the business. So why audit is important? Because it helps in understanding whether the system of accounting is appropriate. Reviewing the system and procedures to find out whether they are adequate and comprehensive, and incidentally whether material weakness exists to allow frauds and errors going unnoticed. Verification of the authenticity of transaction entered into by making an examination of the entries in the books of account and the relevant supporting document, ascertaining proper distinction made between items of capital and of revenue nature, and that the amount of various items of income and expenditure adjusted in the accounts corresponding to the accounting period, and comparison of the balance sheet and P&L with the underlying record. So again, these set of points which you can see on the slide, this is part of the audit, and this is why audit is important, not just for the regulator, but for the stakeholders and the business as a whole. Now, I just want to add here that use of professional judgment is critical, and that is again given SA 200. So what is professional judgment? So professional judgment is application of relevant training, knowledge, and experience within the context provided by auditing, accounting, and ethical standards in making informed decisions about the course of action that are appropriate in the circumstances of the audit engagement. Professional judgment is necessary in particular regarding when you make these decisions, and you will see there is a separate standard for each of these aspects. So materiality and audit risk, you have a separate standard. Materiality we'll cover in a later slide. Nature, timing, and extent of audit procedure used to meet the requirements of the essays and gather audit evidence. So again, you will decide based on your professional judgment what kind of procedures you want to perform. You want to do substantive procedures, you want to perform analytical procedures. So that is governed by SA 500. Evaluating whether sufficient appropriate audit evidence has been obtained and whether more needs to be done to achieve the objectives. What is the objective? To give a reasonable assurance, to give a true and fair view. So again, SA 500, SA 501 are the standard which talks about audit evidence. Evaluation of management judgments in applying the entity's applicable professional financial reporting framework. So again, this is an ongoing assessment which the auditor makes even at the time of audit and before issuing the audit report, drawing of conclusions, so based on the audit evidence obtained, and ultimately report in a form of an audit report under SA 700. So you will draw a conclusion, for example, assessing the reasonableness of the estimates made by the management in preparing the financial statement. A very important point, professional judgment needs to be exercised throughout the audit. So it is not something that you have done at the time of planning or at the time of, you're doing audit when you're conducting your vouching and the other set of procedures, inspection, observation, but it has to be throughout the audit. Now let's talk about the audit risk. Again, it has been explained in SA 200. So what is audit risk? The audit risk is the risk that the auditor expresses an inappropriate audit opinion when the financial statement are materially misstated. But again, it's a matter of professional judgment rather than a matter capable of precise measurement. And again, audit risk is something which is underlying, and therefore an audit is not a guarantee. Now, audit risk is a function of the ROMM, which is called the risk of material misstatement and detection risk. There are, if you look at the second report issued by NAFRA, they have discussed a lot about risk of material misstatement. They have mentioned about that there was a collusion between management and the auditor. And therefore, the auditor has to exercise professional judgment and make sure that all such judgments is documented well in the working papers. I think I've not mentioned about the documentation yet, but just keep in mind that whatever procedures you're performing or whatever additional evidence you are obtaining, or even you are discussing with your clients, which could be a company, a promoter-driven company, or a small owner. So depending on the entity, you will have to document in your working papers. The ICAI committee has issued a checklist also, which was long back by the committee of members in practice. I would encourage all of you to use that checklist. There is a publication also for committee for a small and mid-sized practitioners. They have issued a publication wherein they have given some formats which can be used by the auditors. Now, risk of material misstatement. Let's talk about audit risk comprises of which, what is risk of material misstatement. Then it has to be assessed at two levels. One is your overall financial statement level. So which means there's a risk that there could be a misstatement which could be impacting the financial statement as a whole. So for example, revenue recognition. Now that could be one area wherein companies may want to inflate revenue or to defer revenue just because, for example, in the COVID situation, many companies would want to book revenue in the next let's say not in March, but in April, to show the position is improving gradually. Whereas the fact is the position may not have improved, and that could be only a deferment or the delayed recognition of revenue to change the financial position or to change the balance sheet of the company. So one is your overall financial statement level, and second is your assertion level for classes of transaction, account balances, and disclosure. So here it has to be assessed in order to determine the nature, timing, and extent of further audit procedures necessary to obtain sufficient appropriate audit evidence. So for example, for a related party transaction, you may want to exercise, in detail procedure. You may want to obtain independent confirmation. You will check whether the company has obtained approval from the board of directors, from the audit committee, as required by the Requirement of Companies Act 2013. Now, what is detection risk? Detection risk is that the function of the effectiveness of an audit procedure and of its application by the auditor. So matters such as adequate planning, proper assignment of personnel to the engagement team, application of professional skepticism, and supervision and review of the audit work performed reduce the possibility that an auditor might select an inappropriate procedure, misapply an appropriate audit procedure, or misinterpret the audit result. So again, this is something, it only reduces the possibility. It does not eliminate the possibility. So if the auditor has conducted, has planned the audit in advance. So for example, you receive an audit now, let's say for the next year, and now you want to see that, for example, you have to audit a bank. So you will look at the experts who are aware about the RBI banking regulation. You may have to look at your team members who have actually worked on the banking client, and therefore you may want to say, okay, fine, this person could bring more experience or more expertise about the banking sector. You do a well planning that this is how you will conduct the audit, the information you will obtain from the management, and then you exercise your professional judgment and review the work performed. So this is something important, but again, it's not percent guarantee that there will be no risk, or but again, this is what the audit risk comprises of. Now moving on to the next slide on the assertion, the use of assertions. You have the assertions used by the auditor to audit the financial statement, which are captured in SA 315. So what are those assertions which the auditor use for auditing the financial statement when we talk about any item? So it could be fixed asset, for example, your property, plant and equipment. So one is your occurrence, so which means the transaction and events that have occurred have been recorded and pertain to the entity. So if a company has acquired a building, let's say, or plant and machinery, whether that have been recorded in the correct financial reporting period, whether they are invoices, completeness, all such transactions have been recorded. Accuracy, amounts and other data relating to recorded transaction and events have been recorded appropriately. Cut-off transaction and events have been recorded in the correct accounting period. So when I gave you an example of the revenue recognition, that the company may want to defer revenue recognition to show a better position in the next year, then that's what is the cut-off assertion. Classification, transaction and events have been recorded in proper account. So if borrowing cost cannot be capitalized as per principle of AS 16 or the Ind AS 23, then that should not be capitalized and should be expensed off. The classification and the appropriate headings are also very important. Account balances at the period end, when we talk about the balance sheet, we'll have to, for example, the existence is one of the assertion, asset, liability and equity interest exist. Rights and obligation, entity holds or controls the right to asset, and liability are the obligations of the entity. Completeness, all asset, liability and equity interest that should have been recorded in the books of the company. Valuation and allocation, asset, liabilities and equity interest are included in the financial statement at appropriate amounts, and any resulting valuation or allocation adjustment are properly recorded. Now I'm moving to the ethical requirement and why it is important to understand ethical requirements. There are two reasons. One, as a chartered accountant, you are governed by the code of ethics issued by the ICAI. Whenever you are performing any attest function or any of the responsibilities as in chartered accountant. Code of Ethics 2020 was issued in 19, and then some of the provisions were deferred again. For example, the NOCLA, non-compliance with laws and regulations, and some of the taxation principles, and they're applicable now from 1st January 2022. Besides that, the Code of Ethics has already been issued and applicable. It was made applicable on 1st July 2020. Secondly, in your audit report also, if you look at your opinion paragraph, therein you mention that based on the procedures you've carried out and you are independent and you comply with the ethical requirement. Every auditing standard, now you will have the reference of the Code of Ethics, the ethical requirement, and therefore it is important to understand and comply with the Code of Ethics requirement. This is a very brief summary, but I would encourage you to read Code of Ethics as well, the revised Code of Ethics. So again, the 5 principles given in the Code of Ethics talks about integrity of the auditor, objectivity of the auditor, professional competence and due care, confidentiality. So auditor is governed by the principle of confidentiality, and therefore we cannot disclose any of the information obtained during the course of the audit to any other party other than the party which has engaged us. So other than the client or other than the auditee, we cannot give any information. So whenever any third party writes a letter to us for seeking information, because of the Code of Ethics, we do write to them that we are governed by the confidentiality requirement and we cannot share any information. Now, there are some provision wherein we have to give the information to the regulator. So if the regulator asks for any information, then we'll have to first inform to the company that we have been asked to share the information, and then we share the information with the regulator. So that's why it is important to refer to the Code of Ethics principle whenever we face such situation. Another example which I can give you is a professional courtesy clearance. For example, when you are appointed as a new auditor, which means when you get a new audit. So you have a responsibility under new code of ethics to get a no objection kind of a clearance, which is called practically professional courtesy clearance from the erstwhile auditor, to check whether there are any issues due to which you should not accept the appointment of the auditor. Now, the new code of ethics make it mandatory not only for the incoming auditor, but also for the outgoing auditor to respond. So which means there is responsibility cast on both the incoming auditor as well as the outgoing auditor. You obtain that, you send a letter, you ask for the issue, the outgoing auditor will highlight the issues if there were any significant issues due to which the auditor has resigned. And basis that, you will decide whether you want to continue with the appointment, whether you want to accept the audit, and if there were many qualifications on the audit report, then you have to factor in your next year audit. So the entire guidance is given in the code of ethics. So therefore, it's important to refer to the code of ethics. Independence is also something which is largely governed by Companies Act, but also by code of ethics. So the code of ethics contain the independence principles as well, that there should be independence of mind and independence in appearance of the auditor. So auditor should be independent throughout the audit or throughout whenever an auditor is conducting any test function or performing any assurance engagement. Now let's come to the audit strategy and audit planning. So the key message in this slide, if the auditor has planned the audit, well in advance, then you say 30-40% of your work is already done. So which means what the standard encourages the auditor to spend sufficient time in the planning to identify the important areas. So if you get an audit, if it's not your continuing audit, or even if it's a continuing audit, you will obtain information about the company, the industry. What is the governing regulation for the industry? What are the key factors impacting the industry? What was your prior year audit experience? If you do not have an experience on that company, you may want to talk to any other, your peer group. So you can talk to the erstwhile auditor or to the auditors of the other companies in the same sector. You look at the financial statements available in public domain, you look at the annual report, you look at the website of the company, obtain as much information as possible. So I think the planning starts with the fact that you have to establish an overall strategy that set the scope, timing, and direction of the audit, and that guides the development of the audit plan. So SA 300 is your audit planning. So you identify the characteristics of the engagement, what kind of factors which will determine your team's effort. You determine how much resources are required. So whether 2 team members are required or it's a larger company, you require 20 team members. I think that is depending on the size of the organization. And then you develop an audit plan. So you have to determine the procedure, what kind of procedures you will carry out for conducting an audit. Audit planning is a continuous process, but if you have planned well in beginning, you can keep on updating your audit plan. Now I'm coming to another very important section, materiality. I think many of you, in my past experience also, many people ask this question on audit materiality. What are the documentation requirement for the audit materiality? So audit materiality is an important consideration for the auditor, and this is an overriding principle or fundamental principle, I should mention, because this empowers you to take a judgment, to exercise your professional judgment, to determine your materiality call when, to determine your materiality level when you are deciding whether to include a qualification or not to include a qualification in the audit report. So if you look at the revised guidance note on CARO also, it talks about standards in auditing and materiality. So if something is highly immaterial, let's say it's a large company and some 2-3 lakh fraud has happened, right? The employee would have raised fictitious invoices, booked commission, and there's a loss due to which the company has a 3 lakh of the loss. The standards in auditing and the materiality principle gives you that leverage to see whether that fraud of 3 lakh is material or not. And therefore, the standard is very important to understand what is materiality. How do I document that in my working papers to show that tomorrow, if any inspection happens or if regulator has a question, how can I demonstrate through my working papers that I have determined materiality in accordance with SA 320? Also, you can revise materiality. So there is no prohibition. So for example, if you determine a particular materiality level, then you can revise in as the audit progresses if you get a further information. Now, what is materiality? So a percentage is often applying to a chosen benchmark as a starting point in determining materiality. So for example, you can take a percentage of your profits. So it could be based on element of the financial statement. So many of the companies take 5% of revenue, 5% of expenses. It could be based on asset or liability or equity as well. So the items on which the attention of the users of the particular entity financial statement tend to be focused. So for example, most of the, when you look at the financial statement, even if when you as a user, you are using the financial statement, you will see how much is the profit earned by the company, what is the revenue of the company, how is it changed as compared to the previous year, what are the net assets of the company, where are the company has invested. So, and nature of the entity is also very important. The entity's ownership structure, whether it's a highly leveraged company, which means the entity is financed solely by debt rather than the equity. So these are some of the benchmark. So basis that you can choose any of these benchmarks depending on the company, and you determine your materiality level. So determining materiality for the financial statement as a whole. So you will determine materiality and document in your working papers. The next slide gives you an example of appropriate materiality benchmark. As I mentioned, there is a standard SA320. Also, there is a compendium of implementation guide, which has plenty of examples in determining on determining materiality. So there's a guide on SA320 as well. So it could be your earnings based, which could be your pre-tax income, your EBITDA, gross margin. It could be based on your activity, which could be your revenue, operating expenses. It could be capital based, equity, assets. The chosen benchmark, if you look at the most common, it could be your based on current prior period financial results and financial position, budgets or forecast for the current period. And it has to be determined as a percentage to be applied. So as I mentioned, it could be a percentage of your chosen benchmark, which could be your based on earnings, your income, your EBITDA, or it could be based on your revenue. Now, other key considerations or the aspects relating to materiality. So determining materiality for particular classes of transaction, account balances, or disclosure. So you can determine it for a particular class of transaction as well. So misstatement, and when you are using a materiality threshold, then misstatement of lesser amount than materiality for the financial statement as a whole could reasonably be expected to influence economic decisions. So what is important point here is that when you've set up a materiality threshold, for example, as an auditor, let's say you have 50 lakhs as your materiality threshold. So, but you have to keep in mind that the amounts lower 50 lakhs could also be relevant for the decision maker. And therefore, the factors which could be important are whether law, regulation, or the applicable financial reporting framework affect users' expectation, key disclosure in relation to the industry. So therefore, understanding the nature is also very important. So for example, if the fraud amount in the same example was only 45 lakhs, but it has been due to the involvement of the senior management of the company, or maybe it's a very simplistic example, but I'm more talking about the qualitative qualitative issue. So if you believe even if the amounts is less, but it's such of a significant qualitative, so you could consider that amount as a qualitatively material amount, and therefore it is important to report because it could be relevant for the users to know that it pertains to the management of the company. Then there is a performance materiality concept. So here aggregate of individually material misstatement may cause the financial statement to be materially misstated. Therefore, performance materiality is set to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatement in the financial statement exceeds materiality for the financial statement as a whole. Again, not a mechanical exercise. So your performance materiality threshold is lower than your overall materiality threshold, and which is again based on the professional judgment of the auditor. Changes to planning decision. As I mentioned, planning is a continuous process. Auditor to update and change the overall audit strategy and the audit plan as necessary during the course of the audit. Auditor need to consequently update that procedures based on the revised consideration of assessed risk. So if I just take an example of the last year's audit, and even in the current situation of COVID-19, wherein nobody had a clue how to conduct audit remotely throughout your 100% audit. So the most difficult challenge came on the inventory verification. ICAI issued a guide on physical verification of inventory, on which I also had the opportunity to work. So therein they gave you multiple options. In accordance with the standard, the first thing they referred is SA 501, which talks about that physical verification is mandatory. But if you cannot perform, then you can perform, the management can perform at a later date, but you can observe at a later date, and you perform the roll forward procedures. The second option was giving by using the services of a third-party chartered accountant or engaging with a third-party chartered accountant. Therein, you will issue the instructions, which means, for example, you cannot travel to a remote location. The another chartered accountant who is based out of the remote location can visit the premises of the company, can conduct an inventory verification and show you through the technology, means through your video conferencing, and then perform the inspection and share a report back with you. And the third could be, in a very limited cases, you can simply rely on the video conferencing using your Zoom or your any of your video conferencing technology, where you can observe the management conduct the physical verification and thereby issuing the report. So again, what I was trying to give you an example here, that depending on the situation, depending on the nature, depending on the factors impacting the company, you may have to perform change the audit procedures. Also, just to clarify, no relaxation was given by the Institute of Chartered Accountants of India at any point of time from the requirements of these standards in auditing, even at the time of pandemic, even at the time of first wave, second wave, the auditing standards were always mandatory and still mandatory. So make sure your documentation is complete when you will be signing your audit reports for March 2021 for many private companies. You make sure that your checklists are there, the documentation for your revision, for your every audit procedure you're performing are maintained well in your working papers. This slide is just on COVID-19 revision to materiality, just to give you an example of how materiality level changed when the earnings were affected. So if I, as an auditor, I took, let's say, 5% of my earnings as my materiality threshold. Now, what happened because of COVID-19, the earnings were impacted. So which means the threshold was significantly impacted. So what the guidance was there in the standard also, in such situation, the auditor needs to revise materiality if the information during the audit would have caused him to determine a different amount for materiality had auditor known that information initially. So if I talk about March 20 result, nobody would have envisaged that situation. So if you have set a materiality threshold, you may have to revise it before you issue the audit report. You can consider changing the measurement basis if there is evidence that other financial statement measure becomes more important. So you can choose to decide materiality threshold based on assets, based on any other threshold. And auditor may normalize earnings by removing effect of COVID-19 if the entity has been profitable historically, but because of the current situation incurring a loss, and the entity has experienced unusual transactions that are unlikely to occur. So again, the message here or the principle here is you may have to revise the materiality threshold, and the standard does not prohibit you from from such revision in the materiality threshold. Similarly, for the supervision and review, I think we faced a lot of challenges in remote audit. I'm sure in some cases, for some of the location, this might be the situation. So the obtaining evidence is something very important. If you're relying on electronic evidence, make sure you're having meetings with the client on Zoom or on video calls, make minutes of such discussion, ask for the original evidence, tell them to show the original invoices, and maintain documentation for all these procedures before you conclude and issue an audit report. Now I'm moving to another very important section, audit evidence. So SA 500 and SA 501 are the standard which deals with the audit evidence. Audit evidence could be anything. It is your information which you have used. It could be vouchers. It could be based on your inspection. It could be your inquiries. So there is a whole set of procedure which an auditor could perform for obtaining the evidence on which the auditor's opinion is based, and it includes both information contained in your underlying accounting records as well as information obtained from other sources. For example, seeking confirmation from the debtors, from the lenders. Auditor is responsible to obtain sufficient appropriate audit evidence, and sufficiency and appropriateness not as such defined, but both are interrelated, defined qualitatively, but you cannot in a way measure that. What is sufficient is a matter of a professional judgment. So sufficiency is a measure of the quantity of audit evidence, and it is affected by your assessment of the risk of material misstatement, the quality of audit evidence obtained, and appropriateness is a measure of the quality of audit evidence relevant and its reliability in providing support for the conclusion on which the auditor's opinion is based. Now you can perform or you can obtain appropriate audit evidence by performing any of these procedures or a combination of these procedures. These are illustrative procedures. It could be inspection, which means looking at the books of account, inspecting them, checking the invoices, observation, external confirmation, reperformance, analytical procedures, and inquiry. All these procedures have been discussed in SA 500 and which the auditor can use. Test of controls can be there, of substantive procedures can be used by the auditor. Now moving on to SA 501, as I mentioned, that the two important standards which are important for audit evidence perspective. So another one is on SA 501. So there's a standard which was really played a larger role when even the ICAI was developing a guide on the physical verification of inventory at the time of COVID. So if you look at SA 501, what is important is that auditor has to be physically present at the time of the inspection of the inventory or the physical verification of the inventory to evaluate management instructions and procedure for recording and controlling the results of the entity's physical inventory counting, observe the performance of the management's count procedure, inspect the inventory, and perform test count. Second is completeness of litigation and claims. So you would have seen a lot of litigation or the cases, legal cases pending against the company, filed by the company. The company would have filed a writ petition. The company would have filed a petition which is pending in any of the appellate tribunals. So what is the auditor responsibility under SA 501? The auditor has to inquire with the management, and where applicable, others within the entity, including the in-house legal counsel. There could be in-house legal counsel. Review minutes of the meeting of those charged with governance and correspondence between the entity and its external legal counsel, and review legal expenses account. Presentation of segment disclosures and segment information. So, so the auditor is required to obtain understanding of the methods in determining segment information, whether it is as per the standards, accounting standard AS 18. So evaluate whether such methods are likely to result in disclosure in accordance with the applicable financial reporting framework, and testing the application of such methods.
Excuse me, ma'am.
Yeah,
I have a query here.
Yeah, sure.
Ma'am, as far as litigations is concerned, it generally happens that in case of revenue litigation, like taxation, income tax or GST, and we have to report in CARO the pending litigations with the company, right? So we have to justify, we have to inform the amount involved in that litigation. Now, what happens is that suppose in case of a search case and or other cases, the amount goes in a voluminous amount, which is very on a very higher side. Okay. So once you report this amount, various stakeholders or bankers, what they do is they reduce that amount from the net worth of the company, which results in poor parameters for that company.
When you say reduce, which means for their reading, right?
They reduce, but from the net worth, they reduce the demand, whatever is litigated.
Yeah. So, and if I just ask you, how do you report it? So you may report it as a EUM, right? As per SA 706, and the management may give a detailed note. See, what happens is that the litigation, what the standards require, that wherever it's quantifiable, that needs to be quantified, right? And therefore, it is important that the company obtain a legal opinion and give it to you. And the way they should draft a very detailed note. It is very important for the management or the company to draft a detailed note of showing that giving the perspective of the management. So for example, if a litigation is pending and because of which the demand has been raised on the company, taking your example, then the company may mention the amount of demand, but at the same time giving the perspective that, that this has been for which the writ petition has been filed by the company or whatever action they have taken. and they have obtained a legal advice basis on which they believe that the liability may not, is not tenable. So they have to be, the use of the words is very important by the management. And if the amount is material, I'm sure that you will include an emphasis of matter paragraph. And in that case, you will clearly mention that attention is drawn to the whatever the management has written there by just reiterating. And then you mention that it's not modified in respect of the matter. So the fact that the management has given a detailed disclosure, the fact that you are only drawing attention to a matter, you're not qualifying it. I think it is important for the users to understand that it's not that the demand has been crystallized. If the demand has been crystallized, then they should have be recognized a provision or make the payment. So
Right.
I think that the note becomes important because you cannot reach out to all the users and the stakeholders.
Actually, it happens that there are two cases, like when the demand is from the department, and
Yeah.
suppose in appeals or tribunal, you win the case, and
Yeah.
the department goes against you in High Court or Supreme Court.
Yeah.
So since the demand you have won from one jurisdiction, but since it is pending, one issue. Secondly,
Yeah.
there are issues which, in case of high tax demands or in search or survey cases, cases go on for like 15 years, 20 years.
Yeah.
From jurisdiction to jurisdiction. Actually, it happens is that at one point of time, the demand is not the issue, but the legal questions become an issue.
Yeah.
So I want to understand that once you quantify the demand, they don't go for the write-up, whether it is tenable or not. Once, because ultimately the management believes that they don't have to pay. That's why they're litigating the demand.
True.
So, but the bankers and all, they go on reducing it without taking any cognizance of what management is doing in this. So that is there any way out how to handle it, or we need to report the amount as well?
No, I understand. I understand your point, and this is what is happening. If you pick up I'll give you an example of key audit matter here. If you pick up now there are many publications in public domains containing the compilation. Many of the companies, and I'm talking about the larger firms, larger companies, have given litigation as a key audit matter. Okay, they mention the amount. The amount is very clearly given in the note. Now, if the bankers are reducing it, it is the management responsibility to explain that had this been a demand on the company, or had it been has to be paid by the company, then the auditor also would have qualified it. Not just because there is a litigation, because litigation is something very common depending on the industry. Right now, for every income tax litigation is something very common. There could be a legal litigation. If you've asked me what is your responsibility, you are doing right. Your responsibility is to report the amount. If the management is not reporting the amount, even in the management note, you need to tell them. So I've seen both the cases wherein the management always includes a note. The auditor may or may not include it in the EUM paragraph because they just draw attention to that para. So if the management is including the amount in the note with the clear explanation of the perspective, and you are giving the explanation you are including an EUM, that is what your responsibility is. Perfectly fine. You have complied with these standards. Now it is for the management to explain to such bankers or to such other regulators, wherein that this is what is there in the auditing standards, and this is what is the situation. It is very difficult to say, I can't tell the management to remove the note. I can tell you to take out the EUM if the matter is material. So I think that's more of the practical challenge you are talking about because of the gap in understanding of the the
because
regulator.
In CARO, mandatorily we have to report all the pending litigations with the company.
Yes. And now if you look at your new CARO, I'm not sure whether you kept a session on CARO 2020 or maybe you can keep it later on. See how much voluminous reporting will be required, not just on the litigation, on the loans, on the borrowing, on the investment. I don't know how much as an auditor you will keep on reporting and how much questions will be keep on coming to you. But just remember one principle: if something responsibility is cast on you as a factual reporting or as any reporting, you need to report it, because when you are putting your signatures and affixing your seal, then it is your responsibility that you're reporting everything in compliance with the standards.
Right. Thank you.
Yeah, you're welcome. Sorry, if there is any other question, I think it's been an hour. I'm talking. So maybe we can take up any other question as well. Anyone else want to share your experience you know.
I think there are no queries in the chat box as well.
Okay. So I'll move to another important section then, probably wherein I'm just skipping for the inventory verification. I'm coming to another very important section on going concern. And I would encourage all of you to share your experiences on going concern. And I'm sure this is something, which you would have faced in some way or the another. So what is a going concern assessment? We all know there is a standard called SA 570. And I'll just first explain the principle, and then let's discuss the different situation which you may face as an auditor. So under SA 570, there is a underlying presumption, and if you know AS1 and under Ind AS, that the entity is a going concern and will continue its operation for the foreseeable future. So this is a rebuttable presumption, which you can say. And if you are just not commenting anything on the going concern, even in the pre-revised SA 700, there was no specific requirement on going concern. But now in the revised SA 700, there is a specific comment which the auditor has to make. But ultimately, the underlying assumption is the entity is a going concern, at least for the next 12 months from the reporting date. Now, auditor has a responsibility to conclude on the management's use of going concern. So auditor has to conclude by looking at the cash flows, by looking at the next 12 months cash flows, what are the inflows, outflows, what are the orders in hand, and whether the company has losses, whether the company has liabilities payable in the next 12 months. And basis that, the auditor will have to decide whether the going concern assumption made by the management is appropriate or not. Now, this slide gives you an indicator. These are only illustrative factors given in the standard. Now, I'm not saying it's a comprehensive list. There could be additional indicators as well. So if the company has a net liability or a net current liability position, indications of withdrawal of financial support by creditors, negative operating cash flow, adverse key financial ratio. You will see now in the revised schedule 3, financial ratios are mandatory to be given by companies, and there are so many debt equity ratio and so many other ratios which are required to be disclosed by the company. And the exposure draft issued by the ICAI this morning has the appendix B, which has even the formulas for computation of financial ratios. So if the ratios are negative, if the company has not complied with the debt covenants, or the company is a highly leveraged company, if there are losses in the company, then it could be a financial indicator which should raise a red flag for you as an auditor, and you should evaluate whether going concern assumption is appropriate. Similarly, for the operating, I think all of us have seen practically the significant impact which happened, especially in COVID-19 also, on the hospitality sector or the airline sector. So we have to see what are the factors which are impacting the operations of the company. Many of the smaller companies have shut down their operations. If there is a loss of key management, so suddenly if the board of directors are resigning, the independent directors are resigning, what is the reason? Why, what is the issue with the company? Loss of a major market, if because of the technology, if something is, the restaurants, the hotels are shutting down. So again, is it because of the current situation? So again, one has to assess the operating indicators. And then there could be other indicators, non-compliance with capital or other requirement, such as solvency or liquidity requirement, pending legal or regulatory proceeding. So if there is a legal or regulatory proceeding pending against the company, and if the outcome could impact the going concern of the entity. So these are some of the factors which are given in SA 570, which an auditor should evaluate before making that assessment. Now let's look at the situation on the reporting implication. Now this slide gives you 4 different types of situation. One, where there is no going concern issue. The entity is fine, profit making, not a highly leveraged company, sufficient cash flows to operate for the next 12 months. Then in that situation, going concern based of assumption is appropriate. No specific disclosures are required in the financial statement, and no specific reporting is required in addition to what is there as part of your standard report under SA 700. Now, if you believe that there's significant doubt about going concern, so for example, company has losses, company has incurred losses because of COVID-19, but the parent company has a strong financial position and they have issued an unconditional support letter to the company. or the company has sufficient orders in hand to demonstrate that, or the company's product is such that even though they have incurred losses, but it's a temporary situation, and you believe, looking at the past history, that the company will be able to make profit. Then in that case, you have sufficient mitigating actions or mitigating factors. And then in that case, the entity determines no material uncertainties, and your basis of preparation is also going concern assumption is appropriate. You will mention, the company will mention what are the mitigating factors, and then the auditor has to assess implication. When I said assess implication, again, depending on the financial position of the parent company, in case the parent company has given an unconditional support letter, or looking at the plans of the management, the cash flows or the budget forecast of the company, you will decide as an auditor whether you want to give a material uncertainty paragraph in the audit report, or you just want to, you're fine with the disclosure given by the management. The third situation is where there are material uncertainties, and the mitigating factors are not sufficient to remove that material uncertainty, but going concern assumption is still appropriate. So there could be a material uncertainty because of the current situation. You would have seen even the airlines, the audit report issued in public domain, wherein the auditors have mentioned about the material uncertainty because of the current pandemic, COVID-19, the revenues are going down, or even in the hospitality sector. So when the auditor believes that there is a material uncertainty, the mitigating factors are there, but still it is important to highlight that in that case, the auditor includes a material uncertainty. This is like a EUM paragraph, which means the company has made the disclosures in the financial statement, and the auditor still wants to draw an attention. Before revision of SA 570, it was included as an EUM under SA 706. After revision of SA 570, it is included as a separate paragraph with a separate heading called material uncertainty about going concern. The fourth situation is when the company has decided that they don't want to continue the operation, and therefore there is no realistic alternative also but to shut down the operation because of the losses, because of any other situation, and then the company prepare the financial statement on a liquidation basis. So alternative basis is non-going concern, and in the disclosures will be given in the financial statement. Here the auditor is required to include a EUM. So here material uncertainty paragraph will not be given, but an EUM paragraph will be given as required by SA 706. So this is something very important, which as an auditor, you should keep in mind when you are going to report and make an assessment on the going concern for the company. Now, when evaluating management, the question many times comes when evaluating management assessment of the entity's ability to going concern, what period should be used? The period should be at least 12 months from the end of the reporting period. So you should ask the management to share the cash flow projections for the next 12 months from the end of the reporting period. And if the management is giving you the assessment for a period less than 12 months, please ask the management to extend it to 12 months. As an auditor, you should be alert for and consider the consequences of known or expected event that will occur soon after the 12 months from the end of the reporting period. So for example, there is a debenture, the company has raised money by issuing debenture. Now that debentures are renewable in June 2022, or let's say in June 2021. So if I look at 12 months from the reporting date, or maybe June 2022 only, I'm just correcting my example. So when you're issuing an audit report for March 21, so you believe the company has sufficient cash flows for repayment of the for meeting its operating expenditure till March 2022. But in June 2022, the amount of debentures to be redeemed or the obligations to be repaid, the company has no sufficient fund. So then in that case, you need to ask from the management, what are their plans, how they're going to repay the debentures. So in that case, again, you will have to be alert that it should not happen that, for example, if you have issued the report that, okay, you said it's 12 months has been done, but after 12 months in the 13th or 14th month, the company may not have funds. Then in that case, you may have to consider whether material going concern assumption is appropriate, whether you need to highlight this fact in your MURGC paragraph, which is material uncertainty related to going concern. So again, depending on case-to-case basis and your practical situations in audit, you can decide about the reporting. Now, these are some of the examples of going concern assessment. So first example is company A has incurred losses during the current year and is expected to incur losses in the next year also. impacted due to overall negative economic factors, including sector slowdown, company dependent on having access to credit facilities to be able to maintain its working capital requirement. So the mitigating factors given by the company: binding agreement entered post year end with lenders for additional credit facilities, new products launched after year end, management intends to cut cost, manage liquidity by deferring non-compulsory capital expenditure, unconditional support letter from the parent company. Now, if you are the auditor of this company A, will you include any material uncertainty paragraph in your audit report? Anyone would like to answer this? Any of your views? So there is pin drop silence. So I'm sure all of you are listening to me.
Yes, I'm actually.
Yeah. So again, it's judgmental whether whether binding agreement, new products launched, whether you are convinced with the plan given by the management or the mitigating factors given by the management to you. Now, this factor is very important: unconditional support letter from the parent company. So as an auditor, you should ask about the financial position of the parent company, look at the financial statements available in the public domain, and if the parent company is of good financial position, there are no losses in the parent company, and parent company has given an unconditional support letter, then in that case, it is sufficient that the company should make a disclosure in the financial statement. And as an auditor, we may not include anything in the audit report, but please make sufficient working papers and document this in your going concern assessment, that basis these mitigating factors, you have concluded that the management assumption of going concern assumption is appropriate.
Yeah, one concern I have is a going concern test, assessment, what we do. So we have to reassess all the assets on their realizable value. Is it a mandatory condition?
No, we are not preparing the financial statement on liquidation basis, right? So we are the financial statement on historical basis. But if the company is giving you a mitigating factor, let's say I have a land, okay. In my books, it's recorded at a nominal value because when I purchased it years back, it was not of that value. But now when the company is telling me that as a mitigating factor, they have this land which they can sell off if required, then you should question the management, give you the valuation basis. Is there a circle rate available for that land? Is there any other market price available? Would you like to involve a valuation? So you don't have to do the valuation or the realizable value of the assets at the end of every balance sheet date. But what you have to see, if the company is into losses and if the company may not have sufficient funds to meet its next 12 months liabilities, then in that case, you have to look at, why the company believes that the going concern assumption is appropriate.
Right. So in that case, what I feel is that suppose a going concern assessment fails, the company fails for the going concern criteria, then we need to reassess all the assets of the company on the date of balance sheet. And that too is a very lengthy exercise because in that case, we need the support of the management. But we need to qualify that management is not supporting for revaluation, fair valuation of assets. Okay, how? Because for example, you can take that all the assets of the company are being under bank's possession. Yeah. Because of the default. Now on the balance sheet date, all the assets are with the bank, and the company is default. But promoters are managing some activity on their own, some business activity. So will we consider it as a going concern? One, and secondly, if not, then how do we take the fair value of the assets?
No, again, I think you very well answered the question also. You cannot do the fair valuation at your own. Now, in some cases, you may have to, but again, it's not a mandatory requirement. If you believe that the company is not supporting you, it's not cooperating with you for getting the valuation done and company has losses, then in that case, if you can get so I'll give you an example for my firm. So for example, we are doing an audit of a company. The company has done the valuation, but we are not happy with the valuation because they have given it from any other third party on which we may not want to rely. Now, depending on the size of the company, depending on the audit fees, I may decide to take the services of an internal expert, which is called the auditor's expert under ISO 620, and I may involve that expert in assessing the valuation, whether the valuation given by the company is correct. Now, that may not be possible in each of the situation. Practically, it may not be possible in 100% of the cases. So what you will have to do as an auditor in that situation is that if the management is not cooperating with you, not sharing the valuation, then you may have to treat it as a scope limitation. And when you say a scope limitation, then you cannot conclude whether the going concern assumption is appropriate. So depending on the losses, depending on the funds available with the company, you may have to choose between material uncertainty related to going concern paragraph in your audit report or a disclaimer of audit opinion. I would say disclaimer is given in very extreme situations. So if the company has a history of profits, company has bank balance, but the situation is, because of the situation, the company is into losses and therefore there is a material uncertainty, I would say go by MURGC paragraph in your audit report. But if the company has history of losses, the company has defaulted, as you're saying in your example, the assets of the company are pledged to with the banks, or they are under the possession of the banks, then you don't know what is going to be the outcome, and you cannot derive at yourself what are the valuation of the assets of the company. In that case, you may have to give a disclaimer of opinion because it will be a limitation imposed by the management. And I'm just sharing perspective with you, both from the standards perspective as well as practical perspective, that this could be a situation.
Right. Thank you.
Yeah, welcome. So this was the example which we just covered. Now I'm moving to the second example, wherein company A retails garment under a single brand license from a third party and margin is around 50%. The brand licensing agreement set to expire 6 months after the year end. Unlikely that the brand licensing agreement would be renewed, but otherwise the company's positive net worth and sufficient working capital. So there has to be active discussion, and the company should share the discussion between the company and the brand owner. The brand licensor to take over unsold inventory on cost basis if agreement not renewed. Company entered preliminary term sheet with a new brand having global presence. Now this is something very important. So here the company's positive net worth, the existing licensing agreement would unlikely that it will be renewed, but the company has been able to sign a new term sheet, a preliminary term sheet with a new brand having a global presence, and no significant exit of employees and no intention of liquidation by the management. So again, in this case, though there is an operating indicator, but there's sufficient mitigating factor which the auditor can choose to rely on and document in the working papers and determine that, okay, there is a material uncertainty, but the going concern assumption is appropriate. So in that situation, you will include a material uncertainty talking about this brand licensing agreement and the new term sheet that is not finalized, but yeah, there is a mitigating factor due to which you agree that there is the going concern assumption is appropriate. I think I will just skip the example in the interest of time. Yeah, this is the support letter from the parent. As I mentioned that in many cases, practically I also see in day out, the company is into losses. They will give a support letter from the parent company. What the standard require 570 and as well as the implementation guide to SA 570. It requires auditor to assess the financial position of the parent. You look at the financial statements of the parent available in public domain and approving body for providing support letters. So you have to see whether it is approved by the parent's board of directors. And you corroborate the past instance of support provided, so which means whether in the past there is sufficient evidence that the parent has provided financial support to the subsidiary in case of a need, in case the company is unable to meet its obligations. I've just added a slide here for your benefit on CARO 2020 also. This is not there in 2016 as of now. So March 21, this clause is not there. March 22, you will have to make a reporting here. This is over and above your 570. So 2020 requires you to report that on the basis of the financial ratio. Now financial ratios have been required to be disclosed in Schedule 3. So auditor will look at the financial ratios. Aging and expected date of realization of financial asset. I think Ashish, you just covered this point of realization of financial assets you were mentioning. But if you look at the new requirement, it talks about the financial assets. You look at the aging and expected date of realization of financial asset and payment of financial liability and the other information accompanying the financial statement, auditor's knowledge of the board of directors. whether you are of the opinion that no material uncertainty exists as on the date of the audit report, that company is capable of meeting its liability existing at the date of the balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So here the auditor is not specifically commenting on the going concern. What the auditor is commenting on, whether the company can meet its liability, whether there is no material uncertainty that the company will not be able to meet its liability within a period of 1 year from the balance sheet date. The emphasis is on the company's ability to meet its liability as on the audit report date. So it is very important that the emphasis is in the guidance note is also the liability existing as on the audit report date. So the example which I gave you of June 22 debenture redemption. So you have to keep in mind before you sign off the company, whether the company has the ability to meet its liability. So so you will have to consider the interrelationship also, like for example, for a listed company, whether there is a going concern reporting included by the auditor, or even for an unlisted company, if you have reported here anything, whether it has an impact on your main report, which means whether you need to include a material uncertainty paragraph in your audit report. So this will be applicable from next year. Now I'll quickly cover all the internal financial control. You have your guidance note on the reporting under section 143(3)(i). The auditing for the auditor is with reference to the financial statements. You will have to test the operating effectiveness of the control and issue a separate report. And as per the guidance note format, the format of the audit report is included in the guidance note. Also evaluate the impact of the qualification in your ICFR report, in the impact in the main report. This slide just shows you the roles and responsibility for the board, the audit committee, and the auditor. While the board has a responsibility for the setting up the financial control for the entire financial reporting. Here, the auditor has a responsibility only to report on the adequacy and operating effectiveness of the financial reporting with reference to the financial statements. So the words are not there, but it is only limited to the financial statements. The key consideration, as you know, IFC is mandatory for all the companies except for some of the private company which have turnover of less than 50 crore as per the latest financial statement and has an aggregate borrowing from bank or financial institution or any body corporate at any point of time during the financial year less than 25 crore. Many of the teams, many people ask what are borrowings, not defined in the guidance note on IFC, but defined in CARO 2020 or CARO 2016 guidance note. Any borrowing is a wider term. It includes everything. You include loans, short-term loans, long-term loans, borrowing, anything, advances in the nature of loans. So borrowing is a wider term, which you have to look when you look up to this 25 crore threshold. IFC is even applicable to your foreign companies, which means a license office or a branch office. Covers both your standalone and consolidated. So you have to give a IFC report for your consolidated financial statement as well. Only applicable to the statutory financial statement reporting, not applicable to quarterly or half-yearly financial statement. An auditor to provide reasonable assurance to report if the company has adequate internal control in place and whether they were operating effectively as at the balance sheet date. Okay, I'll just skip the control. Now I'm coming to another important section of fraud reporting. Fraud is governed by SA 240. So we all know we spoke about fraud in the beginning. It is an intentional act by the one or more individuals by the management. It could be on the company, by the company. The primary responsibility for the prevention and detection of fraud lies with the management of the company. And this is your fraud triangle in a way. If there is an incentive pressure on the employee of the company or on the management of the company, if there is an opportunity, then the company X or the employee X in a particular way. It exists when an individual believes that internal controls can be overridden. So for example, if I talk about the remote working setup, the largest issue is fraud. In the sense, there could be a complete, loss of control on the segregation of duties. It exists when management individual is under pressure to achieve an expected earnings target or financial outcome. So the companies may choose to do window dressing here. Just to cover up on the losses. So every company is trying to reduce cost. Every company in the COVID situation is trying to, remove employees, shut down their offices, reduce their infrastructure cost, and then show the company is in a better position. So you will have to be careful that if there is any control weakness, if there is any fraud which is not been, which has been perpetrated by the management. These are some of the areas. The foremost area, important area, which as an auditor you should focus is revenue recognition. There should be no overstatement, understatement. You may have to spend additional time on revenue recognition. Related party transaction, another very important area. Increased requirements on related party transaction. Even in CARO 2020, they've added, they want separate disclosure for the transaction with promoters, with related parties, with KMPs. Even in the even in Schedule 3, they have added disclosures on the promoter shareholding. So again, related party transaction is an area wherein you may have to spend a lot of time. Accounting estimate is another area which could be, area susceptible to fraud, because estimation involves judgment, not only by the management, but then you will have to challenge their judgment. Significant unusual transactions. So any unusual transaction which you believe that is questionable, you may have to think about whether it could be related to any fraudulent financial reporting. And control override. So management might override control through various techniques. For example, fictitious journal entry, for which they have introduced this audit trail amendment, which will be applicable from 1st April 2022. So that is something which we have to keep in mind. These are your procedures which are given in SA 240. So I'm not going into detail, but then there could be a management override of control. So you have to test the general entries. You have to review the accounting estimate and perform a review of management judgments and assumptions. I'll skip this. Yeah, fraud reporting under 2013 Act. So if I look at the fraud reporting under Companies Act, which I mentioned 143(12). So therein, if the amount is less than 1 crore, you only have to report to the board or the audit committee within 2 days of the knowledge of the report, and disclose. The board has to disclose still in the board report. What is the nature of fraud, parties involved, what remedial action has been taken. So the amount is less than 1 crore, the company still have to make a disclosure in the board report. If the fraud amount is 1 crore or above, then it has to be reported to the central government within 2 days of knowledge and report to the board and audit committee. So the entire procedure is given in guidance note under section 143(12), the guidance note issued by the ICAI. But one important point which I would like to reiterate here, the guidance note mentioned that only the frauds detected by the auditor while conducting the audit, and it is 1 crore or above, has to be reported to the central government. So which means if the management has identified the fraud, even if it's 1 crore above, you are not required to report such to the central government. This is not coming out of the innovate directly from the provisions of 143(12), but that is given in the guidance note and followed by the auditors largely. A key consideration includes only fraud by officers or employees of the company and does not include fraud by third parties. So this is your current CARO 2016 in a way. But now in 2020, the fraud on the company, by employee, officer, vendors, third parties, everything is covered. So in CARO 2020, you will be required to report all kinds of fraud. Auditor to report if fraud identified in the course of performance of his duties as an auditor, auditor has reason to believe, has acknowledged that a fraud has occurred or is occurring. So the management identified more than 1 crore, so you have to evaluate the reporting obligation under SA 240. You have to look at the steps taken by the management, but this may not require reporting to the central government. Yeah, this is CARO 2020, which I just mentioned, that whether any fraud by the company or any fraud on the company. So they have removed this word by its officers or employees. And herein you will have to report on all kinds of fraud and the amount and nature to be involved. There are other clauses also which you need to consider when you are reporting on fraud, which could be your whistleblower complaint, undisclosed income, and quarterly returns filed with the banks for working capital limits. Consideration of laws and regulation is your SA 250. So as an auditor, we are responsible for compliance with laws and regulation, which has a direct effect on the financial statement. So there are two laws and regulation, one which has a direct effect on the determination. So for example, if the company is required to pay taxation and they have not paid tax, they have not made a provision, and it's a legal obligation, then it's as you know, that has to be specifically reported by the auditor. The second is that do not have a direct effect on the determination of the amount and disclosure in the financial statement. but compliance with which may be fundamental to the operating aspects of the business. So for example, if the company is not complying with the environmental laws, then they may have an effect on the license of the company. Then in that case also, the auditor needs to determine the impact on the reporting. The auditor will conduct the procedures to see whether it has an impact on the going concern of the company, whether there could be any other repercussions on the financial statements of the company. Yeah, these are the procedures. Yeah, I'll just take on the impact on the audit opinion. So if the non-compliance has a material effect on the financial statement and the fact has not been adequately reflected in the financial statement, which means the company has not disclosed the amount of penalty or the possible the punishment or anything arising due to non-compliance, and the auditor may have to issue a qualified or adverse opinion. Auditor is precluded by the management or those charged with governance from obtaining evidence to evaluate whether non-compliance may be material, which means a scope limitation. Then in that case, again, depending on the matter, you may have to give a qualified opinion or a disclaimer of opinion. Auditor also needs to determine whether the auditor has a responsibility to report the identified or suspected non-compliance to parties outside the entity. So for example, if you would have conducted the audit of bank, there is a responsibility on the auditor to make a specific reporting on fraud to the RBI. So there could be a regulatory reporting, and the auditor should evaluate the impact on the audit report as well. Now I'm coming towards the towards the last section, and considering the time, again I'll cover only the important aspects of the audit report here. So you have these 1, 2, 3, 4, 5 standards on the reporting standard. The most important standard is your SA 700, which governs your report, the format of this report, the structure of the report, which paragraphs to be included, what is auditor's responsibility, what is management responsibility. Then you have the key audit matter standard, which is applicable and mandatory only to the listed company. So this is not mandatory to the unlisted companies. And then you have the modifications. So if you want to include a qualification, even because of any scope limitation, because of any incorrect accounting policy, any disagreement with the management, you are not able to obtain sufficient evidence, you will refer to SA 705. And then you have the emphasis of meta paragraph and other meta paragraphs and relationship between UM and CAM in the audit report and auditors. And then you have SA 720. Now, what is SA 720? It talks about the other information. Other information, in addition to the financial statement, the information included by the management, for example, in the board report or in the annual report. So this standard casts a responsibility on the auditor that the auditor should read the other information and see whether there is no inconsistency between the other information section and the information given in the financial statement and the information obtained by the auditor while conducting the audit. So that is your other information standard. Now, this is overall your structure of the audit report. So irrespective of the nature of the entity, company, trust, association, LLP, you have to give an audit report. I understand that the LLP rules are likely to be notified soon, so you may have to check on the report format for the LLP. But if you look at SA 700, the structure of the audit report, there has to be a title, the addressee as per your engagement letter, which will be your board of directors or your shareholders. The opinion paragraph, including so your audit report starts with your opinion paragraph. So you will simply begin whether you are giving a qualified opinion or an unmodified opinion. It will start with your opinion paragraph. Your basis for opinion paragraph, emphasis on matter paragraph, responsibilities of management and those charged with governance, auditor's responsibility, other matter, and then you have a section called report on other legal and regulatory requirements. For listed entities, you have a separate section on the key audit matters. So for every listed company, there is a requirement as per SA 701 that the auditor has to identify the most important areas in audit, so which is called the key audit matters. The matters which in the auditor's judgment were of most significance in the audit of the current period. Reporting on other information, auditor to consider, which I just explained, whether there is a material inconsistency between the other information and the financial statement. If I just talk about the structure of the audit report in detail, there is a management responsibility paragraph, which will include that the entity, the company has the going concern, the company has made the going concern assumption, and whether the use of going concern base of accounting is appropriate. Management is responsible for the preparation and fair presentation of the financial statement. And this section of the auditor's report shall also identify who is responsible for the oversight of the financial reporting process when those responsible for the oversight are different from those who fulfill the responsibilities. So for example, in a listed company, it could be an audit committee. So the audit report will need to clearly bring out if the audit committee is responsible for the oversight of the financial reporting process. Responsibilities of the auditors substantively, significantly enhanced in the 700. So the objective section will increase. What are the objectives of the auditor? To obtain reasonable assurance, to issue an auditor's report that includes the auditor's opinion, and state that reasonable assurance is a high level of assurance, and misstatement can arise from fraud or error. And either you can describe that the misstatement, they will be considered material if individually or in the aggregate they could reasonably be expected to influence the economic decisions of the users, or the auditor also has a choice to give a definition or description of materiality. I've not seen reports except one or two wherein the auditor has disclosed the materiality threshold. So again, it's an option given in the standard, which you can decide to give a description of the materiality threshold within the audit report. Then you have to talk about your ROMM, understanding of the internal control, evaluating the appropriateness of accounting policies, evaluating overall presentation. So this will be part of your responsibility section in your audit report. And then again, you will have to mention that you have to you communicate with the board of directors or those charged with governance about your scope and timing of the audit, significant audit findings, and state that the auditor provide those charged with governance with a statement that audit has complied with the relevant ethical requirement. So I mentioned about the code of ethics in the beginning. It is important for you to comply with that, has to be specifically given in the audit report. And then comes your key audit matter, which is there on the next slide as well. This slide gives you a structure for the modifications to the audit opinion. You give a qualified opinion when you're not able to obtain sufficient appropriate audit evidence. There is a material misstatement. You issue an adverse opinion when you have obtained evidence, but you conclude that the misstatements are pervasive. Now, what is pervasive? There are no bright lines or threshold given in the standard, but if you look at the examples in public domain, so something which could be impacting around your 80 to 90% of your financial statement. So for example, if the misstatement is actually will convert your profit into a loss, or it will substantially wipe off your 90% of your assets. Now that could be a situation where you may have to give an adverse opinion. Disclaimer of opinion is given in limited situation when you are not able to obtain sufficient evidence, or you conclude that the impact could be material and pervasive. So disclaimer of opinion, as I mentioned, are given in very limited situations. This is a matrix given in your SA 705 where you need to exercise your judgment whether you need to give a qualified opinion, adverse opinion, or a disclaimer of opinion. I'll just skip this section and rather will show you an audit report towards the end. Emphasis of meta paragraphs. This is something as we discussed about litigation. Now it could be anything like you would have seen in public domain plenty of example for impact of COVID-19. Many of the listed companies, unlisted companies have given a paragraph on impact of COVID-19 by using SA 706 because of the inherent uncertainty. Because of the COVID-19 impact, it could be impacting the operations of the entity, assets of the entity. So it could be due to a litigation, it could be a regulatory action, or because of such pandemic also. So a major catastrophe, if you can see the last bullet, a major catastrophe that has had or continued to. So many of the companies and the auditor have used this fourth bullet and the auditor reporting guidance issued by the ICAI on COVID-19, and they have included a paragraph for impact of COVID-19. This has to be given with the appropriate heading, and again, it's not a qualification. The recent NAFRA report, which I mentioned, pinpoints to the fact that the auditor has used number of paragraph, which is not the intention of the standard. So use it whenever required. Then you have the other meta paragraph. This is largely used in Indian scenario for highlighting SA 600. When I say highlighting, it's a 600. When a component is not, you have not audited a component, subsidiary, JV, associate, or when you are not the predecessor auditor, then you include in other meta paragraph that this was audited by another auditor. Key audit matter, I'll not cover in detail here. Again, it is applicable. One thing to be given in mind, it is applicable only to the listed company, only for the audit of complete set of general purpose financial statement, and its applicability for listed entity only when the company wants or auditor wants to decide voluntary adoption of the standard, or it is required by law or regulation. So as of now, there is no requirement by law or regulation. But if a company wants to if an auditor wants to voluntarily adopt CAM, then they will have to first talk to the management, agree on the voluntary reporting, and then comply with the standard. So not applicable to the interim financial statement, not applicable to the financial results under SEBI. Key audit matter, as I mentioned in the beginning, you will have to figure out which are your key audit matters, which takes you substantial time, which requires significant auditor attention, and you out of the matters which you're communicating to those charged with governance under SA 260, you determine which require significant auditor attention and which are most significant, and then you determine key audit matter. There are writing guidelines, how to communicate CAM, separate section. There is a detailed implementation guide on 701. I worked on that guide as well when the project was, was being prepared. You can look at the example. Even the illustrative language is also given for the key audit matter. So I'm skipping this. This slide is on the other information. As I mentioned, the responsibility enhanced under revised SA 720. You will have to agree in your engagement letter that the management, before releasing the other information, which could be your annual report, which could be your board report. So anything other information which is going into public domain, before releasing it or before submitting it with the regulator, they should share with you as an auditor for your reading. And you have to read that report to see if there is any inconsistency between the other information and the financial statement, other information and the auditor's knowledge obtained in the audit. And if there's any inconsistency, you have to tell the management to correct it. And if they're not correcting it, then you may have to qualify the audit report. So if I just show you the, coming to the language, just for your reference, you have to write that the companies is responsible for the other information. Other information comprises your annual report, but does not include the India's financial statement. Your opinion does not cover the other information, which means you're not giving any opinion on the other information or any assurance. But what you have to write, your responsibility is to read the other information, and in doing so, consider whether the other information is materially consistent with the India's financial statement or Indian GAAP financial statement or knowledge obtained in the audit, or otherwise appear to be materially misstated. If based on the work we have performed, we conclude that there is a material misstatement, then we are required to report that fact. We have nothing to report. So this is a clean or maybe a factual reporting, I would say, where as an auditor, you did not find any material inconsistency. The standard also gives you guidance wherein you may have not obtained the information by the time you're signing off. And in that case, if the board report is not available by the time you are signing of the auditor report, you have to state that fact. But you also have to agree with the management through a management representation that they will share the the other information before it is released or before it is finalized. Now I'm just coming to the end of the section on and taking you to the recent AQR report. I thought let me just highlight where what are the responsibilities as an auditor and what are the key areas which the regulator is looking at. So one of the theme was formation of audit opinion. So it requires careful evaluation of all audit evidence. Effect of misstatement as per NAFRA report in that particular case is pervasive if it affects substantial portion of net worth or converts profit for the year into loss. So I gave you an example of profit into loss. They have captured this example here. Reiterated that financial statement would not represent a true and fair view if there's a non-compliance with applicable accounting standard, which means you cannot issue a clean opinion if there is any non-compliance with the mandatory accounting standard. Basis for modified paragraphs should be unambiguously and factually accurate. Basis for formation of audit opinion should be supported from conclusion derived from audit procedure, should form part of working purpose. Again, I'm just repeating a very important message. Documentation is very important. What is not documented is not done. So regulator will not consider Nobody will consider anything if you have not documented in your working file, irrespective of the work you have done. Asking right question, exercise your professional judgment, involve legal expert wherein you believe that there's a complex legal matter. Ask the management to get the legal opinions. Emphasize the matter, use it judicially. So in this report, the auditor has used multiple EOM paragraphs, and it should not be used as a substitute for a modified opinion. So that is something, one of the report. The other two report which I mentioned, I've just put up themes here. There was the issue with compliance with independence requirement. In one of the report, they challenged the independence of the auditor. They even challenged that the auditor was not communicating with the management, with the board of directors on a timely basis. There were issues on RBI inspections matter, the evaluation of risk of material misstatement matter. They even pinpointed that the ICAI report was not appropriate. There should have been a qualification. The challenge was also raised on the procedures performed by the auditor. The evaluation of going concern assumption was challenged. Materiality was not sufficiently documented in the working papers. The integrity of audit file and audit firm's IT control review. So they even challenged that the alteration or changes were made in the audit file after issuance of the audit report, which should not be doing, and you should be completing the documentation before you issue the audit report. The EQCR process inadequate and incomplete, SQC1 compliance, the policy and procedure made by the CA firms were not appropriate. So I think these were some of the observation, and towards the end, I've just added some of the ICAI resources. You can refer to the implementation guides, you can refer to the guidance note and the technical guides, the compendium of implementation guide, which I mentioned, which are there on many of the auditing standards. Now I'll stop here, and if there are any questions, we can take up.
Ma'am, one question from in the chat box. CSC Jain sir has asked, a director in the government company appointed in July 2020, but he has not attended any meeting in last 12 months. Where auditor need to report this non-compliance?
Okay, so there's a very specific question that they have not attended any meeting, and it is mandatory for the auditor to attend the meeting as per Companies Act. You will have to look at the specific provision in Companies Act and the non-compliance. So the penalty, is there a penalty on the company? Whether the director will not be eligible for appointment next year. So depending on what is the penalty, the company should make a provision for the penalty. If there is no significant material penalty, then you please ask the management to give you a response in writing, keep that in your working papers, and it may not require anything reporting in your audit report. So when you decide any non-compliance with any law or regulation, you first of all understand what is the repercussion, what is the penal provision because of the non-compliance. Now, if they are not attending any of the meetings, probably they may be disqualified to be appointed in the next year. So I may not have the relevant section in front of me, but you look at the relevant penalty and ask the company to make a provision or take the appropriate action.
Okay, ma'am. Thank you.
Yeah, thanks. So I'll just stop sharing here, but if there are any other question, anyone wants to unmute and ask, I'm more than happy.
Ma'am, please share your PTP so that I can circulate to all the members.
Yeah, I'll share it. I have your email ID. Yeah. Anyone wants to share their experience or any questions you have?
No questions, ma'am. Akansha, you can proceed.
Thank you, ma'am. This session was indeed very informative, and surely it is going to help a lot to all of us. Now, I request CA Gaurav Kansal sir, Vice Chairman of Agra Branch CIRC, to present his formal vote of thanks.
Thank you, Akansha. Thanks. Good evening to all, and thanks to CA Deepa Agarwal for such a wonderful deliberation. इन्होंने ऑडिटिंग स्टैंडर्ड्स के बारे में जिस तरीके से इंटरेक्टिव और आसानी से हमें समझाया, वो बहुत ही हमारे लिए नॉलेज के लिए बहुत ही गेनफुल है। और मैं सीए आकांक्षा अग्रवाल जो आज की मॉडिटर हैं उनका भी बहुत धन्यवाद करता हूं। इसके साथ ही आज बहुत ही अच्छे नंबर्स में मेंबर्स ने इस वेबिनार को अटेंड किया, उन सबका भी धन्यवाद। और दीपा मैम से मैं रिक्वेस्ट करूंगा कि आगे भी हमारी ब्रांच आपको इनवाइट करती रहेगी, आपको परेशान करती रहेगी, तो आप अपना कीमती
वेलकम।
समय हमें आपने अपना वैल्यूबल टाइम निकाल के दिया। थैंक यू वेरी मच। ओवर टू यू आकांक्षा।
Thank you, ma'am. Thank you, sir.
Thank
Sir,
you.
So we can close the VCM. Thanks a
Yeah,
lot.
thank you. It was my pleasure. Looking forward. Thank you.
Thank you.
Thanks, everyone. Thanks for the participation. Thank you.